Hello and welcome to today's video, which is called S&P 500 in Uptrend Now. Yes, this start has been the past week, and within this long video I will walk you through the reasons why, what I expect, and you will also see presented a couple of stock sectoral picks on how to benefit from the unfolding Q4 rally. I hope that you are already subscribed on my site, because you have noticed that the daily analysis have expanded in scope, that I cover more ground, and that I'm somewhat less on Twitter, but always replying, and more attention is going to premium Telegram channels. So make sure that you are subscribed on my site and that you are taking advantage of everything I and Ellen do for you. So let's dive into the big picture. Well, starting with the Monday bullish gap, slowly progressing and the fate being quite sealed following Wednesday's FOMC, being doubted that badly that it did not bring even a 12-hour relief. We had seen a veritable trend change in the stock market. It's my opinion that the Q4 rally has started, and the shape and scope and degree of the upcoming correction would be the only sort of point of uncertainty. We had seen Powell deliver the hawkish pause, but he did not commit to raising rates, and markets anyway, even before that, on manufacturing PMI have decided that this is not the place or the time or the environment to be hiking rates into. The same goes for very weak undershooting, and twice for preceding two readings downgraded non-farm payrolls. The Fed is sticking to its plan of trying to hold restrictive, meaning trying to keep higher for longer, as long as it takes, as long as it is allowed to by the bond markets, which are clearly in the driver's seat right now. We had seen as well quite a confirming change within the Bank of Japan and the yen reaction. The top in US yields is clearly perceived to be in, and it's my contention that the risks of slowly unwinding the yield curve control in Japan is in progress, and that has the potential to move bond markets and volatility somewhat more. But for now, we are seeing solid retreat in yields. The move is confirmed by yen appreciation, which means of course as well that the US dollar top that I had been talking about in prior weeks, that is likely to come within weeks, has happened, and the yield differential either versus the euro or versus the yen is getting squeezed, dialed back, and it decreases the attractivity of US dollar. What else? That's basically quite a few arguments for hard landing presented, which also is something that reflects the retreat in yields, because markets have decided that the job market is starting to show cracks. But I would say not so fast, because job openings are still rising, construction spending is doing okay, factory orders are kind of dialing back the perspective of straight down going manufacturing PMI. Straight down, I mean markedly below 45, saying 43 or 42. We are not yet there, and I think that the soft landing trades would stage some kind of a comeback within the coming weeks. But for now, we are seeing yields retreating, and that's the fuel, that's the key ingredient for Q4, call it Santa Claus rally. So I've covered all the bullet points, enough, very different ordering, but never mind, you have another way how I look at things even without this formal ordering. So let's move into stocks and the key chart that I've posted within our intraday channel later on Friday, but still well before the close. You can see quite a few resistance lines and maybe the horizontal resistance zone as such being drawn, and that means that I'm probably not looking for one-way ride higher. Circumstances simply favor a decent, noticeable pullback. Healthy little, as I say. That's the only variable, the missing piece of the puzzle that would be coming over the nearest week. Because frankly, given my call for sticky inflation that I said already in August would be the fact starting September, with so much of the rising oil prices to be yet making their way through the headline and core, we are likely to be negatively surprised by the inflation figures, which would kind of get the Fed tightening back into the game. So that's what I see for middle of November. We are not yet quite there. So that's the key catalyst that I see ahead. For now, this is the chart and purely technical view of why we may get a decent little pullback to initiate long positions. And now towards stocks and sectoral picks. With the changes in bond markets that I had summarized in the opening part of today's presentation, let's stop with two key winners. One of them would be real estate, and several its constituents, such as SPG, are at noticeably better shape than this sectoral ETF. And as I say in the final bullet point, till the consumer remains in the game, meaning till retail sales remain strong, and till we see decent wage growth and personal income growth, we are likely to see yields benefit, real estate benefiting from the retreat in yields and from the perceived top in yields. And another surprising pick of what would do well, even better than tech or semiconductors, would be regional banking. And all the worries, all the problems within the banking sector, question marks over the degree as to wage exposure to commercial real estate has been offloaded, and what's the exposure to high yields. This can wait and will wait. This will be one of the good participants in the Q4 rally as well. So, I'm pretty sure that you know my journey and the professional bio and all the announcements on my homepage. And obligatory disclaimer with my wishes for a great weekend of yours.